Hello there, finance friends, and welcome back. In our last video, we talked about marginal tax rates. Okay, so we talked about marginal tax rates. And we learned that in America's progressive system, the more income you earn, the higher your marginal rate is. But we also learned that your marginal rate is just the rate that's applied to your next dollar of income. It's not the rate that you pay on your total income. Okay, so that's a really big thing to understand. We also had a couple of implications about that. That if you know what your marginal rate is, then you know how much extra tax you have to pay for each additional dollar you make, but you also can figure out how much tax you'll save if you can reduce your taxable income. And that's what I want to focus on in this video. I want to focus on this critical number, your taxable income. Because as we said before, your taxable income is the basis for your tax burden. We'll say it again. Your taxable income is the basis for your tax burden. Okay. In that systems map we showed earlier, where the federal tax form is just comparing how much you have to pay in taxes to how much you withheld, and then you compare those to get either the refund or the amount due. The tax burden is based on this number. And I want to be real clear. Your taxable income is not your total income. This is really important. To say it in another way, you do not pay taxes on every dollar you earn. Really important to understand this. You do not pay taxes on every dollar you earn. The basis of your taxes is your taxable income. So you say, well, Eric, okay, what does this mean? It's like taxable, this, that, the other. Best way to do it with a little chart. Okay? The best way to understand how this works is this. Here's the formula. You start off with your total income. Your total income. Then you go through a series of adjustments, which we call deductions, to reduce. So we're going to go total income. We're then going to reduce it with deductions. And that's going to yield the taxable income. And again, it's this taxable income that is the basis for tax. So hopefully you're seeing, oh man, there's a gap emerging between what I actually earned and between what I have to pay taxes on. It's a gap. When we say, hey, we want to reduce our taxes, we want to pay less taxes, we want to get a tax break, we want to get a tax deduction, what we mean is we're trying to widen that gap and increase our deductions to pay less. So how do we get there? So starts off like this. We start off with total income. We then subtract what we're going to call above the line deductions. Total income minus above the line deductions. Look here. Where's our tax return at? Here it is. Take a look at this. Let's go to the first page. You can see here that lines 1 through, 1 through 8, adding up to line 9, That's your total income. Okay. All of this up here, oops, line 9, is your total income. So you can see that you're paying income taxes on your wages, on any interest. We learned about dividends. When you're old and get your IRA distributions, any pensions, any Social Security, any capital gains from, excuse me, from selling securities, all of those things become your total income, which is reported on line 9. And you might think, damn, that's a lot of income. Like, I'm gonna pay a lot. Well, maybe not, because you're going to subtract your above the line deductions, and that's going to yield what's called your adjusted gross income, also known as your AGI. And you can see here, oops, you can see here, I think I lost it. Hold on a minute. I got to go back and open it. Sorry about that. There we go. You can see here that we have on line 9 the total income. And then on line 10, we have adjustments to the income. Because this is above the adjusted gross income, we always call the adjusted gross income the line. So the above the line deductions are right here on line 10. Now you'll notice that this is going to stem from a subschedule called Schedule 1, which lists all kinds of potential deductions that you can take. Let me make sure I get this over here so I can use it later. There we go. So above the line deductions reduce your total income. For most people, for most of my clients, and for most of you, your above the line deductions would include traditional IRA contributions, not the Roth. Remember, we said in our retirement lecture that our IRA contribution, a traditional contribution, gives you a tax break now. And you might have heard people say things like, oh man, I need to reduce my taxes. And somebody will say, oh, open up an IRA and contribute to an IRA. And you might have thought, okay, what's the causal mechanism by which contributing to an IRA reduces your taxes? Well, now you know, because your IRA contribution is an above the line deduction. So every dollar of IRA contribution, traditional IRA, not Roth, every dollar of traditional IRA contribution on line 10 reduces, because look at line 11, subtract 10 from 9. So your total income minus your adjustments is your AGI. So traditional IRAs are a big above the line deduction for most Americans. Another one, student loan interest. You may have heard people say things like, oh, I got a deduction for my student loans. You say, well, what's the causal mechanism? How does that lead to that? Well, now you know. The interest that you pay on your student loans is an above the line deduction, and your total income minus those deductions is your AGI. Notice from a political level and more of a social level, we can see that the government is incentivizing people going to college. We can see that the government is incentivizing people contributing to their future retirement. You may have political issues with this, but that's for a political class. This is the way the game is written, and we want to understand the game. I mean, clearly, this right here is probably unfair for people, for the 2/3 of Americans who don't go to college, who either go into trades or the military, let's say. But at the end of the day, this is what it is. So total income minus above the line deductions equals adjusted gross income. But wait, there's more. Because from here, we can subtract your deduction, another deduction, And this deduction is right here. We see on line 11 your AGI, and look at line 12E, standard deduction or itemized. All Americans, all taxpayers are allowed a deduction. So even if you don't have an IRA or you don't have student loan interest, even if you have no above the line deductions, all Americans are eligible for this below the line deduction, which we saw just now. Now, it gets confusing because the government offers you two approaches. You can either take what's called the standard deduction, or you can take what's called the itemized deduction. The government does not tell you which one to take. So basically you and your tax preparer, or you if you're using software on your own, you have to figure out both and you take the bigger one. Again, notice line 12E, standard deduction or itemized. Where do these numbers come from? Well, the standard deductions are right here. They're set every year. You can also see them right here. So for 2026, here's the standard deductions. If you're single, 16,100. If you're married filing joint, 32,200. And if you're head of household, 24,150. Even if you have no above the line deductions and nothing to itemize, you can put the relevant amount based on your status on that line. Now, this is the standard deduction. There's also the ability to do what we call itemizing your deductions. Itemized deductions are done on a schedule known as Schedule A. Schedule A is the itemized deduction schedule. What are some of the things that you can itemize on your Schedule A? Well, the main ones you can itemize are medical and dental expenses, taxes that you pay, state and local taxes only, not your federals. So we'll say taxes, state and local. They call that SALT, by the way. Oops. They call that SALT, S-A-L-T, state and local taxes. You can deduct mortgage interest. Aha. Biggie. We've said before that the federal government incentivizes homeownership. Maybe you've heard people say, oh man, I'm getting crushed with taxes. I got to find a tax break. And somebody will say, oh, you got to get a house. You got to get a house to reduce your taxes. And you might have thought to yourself, what's the causal mechanism by which owning a home can lead to lower taxes? Well, now you see it. Because your property taxes and the interest on your mortgage are itemizable deductions. And especially in parts of the country where real estate's really expensive, you're going to pay a lot of prop tax and a lot of mortgage interest, and you can deduct that. You can also deduct charity contributions as well. So these are the big ones. Notice that today in 2026, the majority of Americans do not itemize. Because in order to itemize, so these are your itemized deductions. In order to itemize, these itemized deductions here have to be bigger than your standard. So for me, I'm single. I just take the standard deduction of 16,100. I would only claim itemized if these totaled greater than this. And since I don't own a home, and I don't have a lot of medical bills, and I don't pay property taxes, then there's really no chance in hell that I'm going to have itemized deductions greater than my standard. You want to take the bigger. So going back to here, it looks like this. We just described your total income minus your above the line equals your adjusted gross minus your deductions. This, my friends, equals your taxable income. And this, as we know, is the key. This is the basis for your taxes. The basis for your tax burden. Okay? So really important idea here. What's the takeaway? Well, the takeaway is you want to pay lower taxes. Therefore, you want to reduce your taxable income. Therefore, you want to do whatever you can to legally take advantage of all the deductions that are available to you. And that is where tax deductions and tax brackets and all that stuff comes in. Okay? So look what we've done. We talked about in our last lecture the marginal tax rates, but we said that they were based on taxable income. We learned the implications, and especially implication number 2, if you can reduce your taxable income by $1, you're going to reduce your taxes by the amount of your tax rate. Well, how do you reduce your taxable income? Well, now we have a roadmap. Total income minus above the line deductions equals adjusted gross minus standard or itemized equals your taxable income. So how do you reduce this? You reduce this by maximizing these. And that's what it means to be a smart consumer, to be a smart taxpayer, okay? Real quick, I want to wrap this up. Well, few things actually. Number one, I want to just show you on the tax return so you can see it. We'll put it all together. You can see that lines 1 through 9 are your total income. Line 9, total income. Line 10, above the line deductions, leading to line 11, adjusted gross income. Adjusted gross income carries here, minus standard or itemized, gives you right here on line 15, the big important, big kahuna number, your taxable income. That's how it looks on the tax return. This is how it looks from like a mapping perspective. And for those of you who like really line by line analysis, I've put together for you this form right here, not form, this little thing I created, which I call the skeleton. And in the skeleton, I give you the description of the thing that happens. I give you the line number that it occurs on the 1040. I give you some notes so you can see sort of what it means. But ultimately, we're getting here from total income to adjusted gross income to taxable income. We then take that taxable income on line 15 and we compare it to how much you paid, and that's your refund or your amount due. Okay? So that's the first thing, the structure. The second thing that I want to point out is this. We talked, for example, about mortgages and interest rates. I spoke up here about one of the big implications. I want to share with you one final thing before we end this video. The tax advantages of deductible expenses. The tax advantages of deductible expenses. I want to point something out. Let's just say that you are in the 28% tax bracket. Let's just say you're in the 28% tax bracket. And let's say that you have a mortgage that charges a 6% APR. Now, we just learned that having a mortgage leads to a tax deduction. And if you have a tax deduction, you reduce your taxable income. Here's the implication. Ready? Here's a couple of formulas for you. Formula 1. Your after-tax dollar amount is equal to your nominal dollar amount multiplied by 1 minus your marginal tax rate. And an extension of that, in percentage terms, your after-tax percentage is equal to your nominal percentage multiplied by 1 minus your marginal tax rate. So let's go back to our example up here. You pay 6% APR on your mortgage. You're in the 28% tax bracket. Well, what does this mean? Well, it means that when you factor in tax considerations, your real interest rate is going to be equal to your nominal interest rate times 1 minus your marginal tax rate. If you have a 6% mortgage, but it's reducing because your mortgage interest reduces your taxable income and you're in the 20% tax bracket, look at this. In effect, your real effective mortgage rate is 4.32%. Because again, you're paying 6, but you're reducing your taxes. And therefore, when you factor in the tax savings, there it is. Let's take it another way. Let's suppose that this year you paid $14,000 in mortgage interest. So you have a nice house. We've learned how to run these numbers. You paid $14,000. You're thinking, damn, I'm paying a lot of mortgage interest. And you are. We know it's a big number. But we have to be tax smart, like this. Technically, you're paying $14,000, but because you're saving 28%, because again, that $14,000 in mortgage interest is an itemized deduction. So the mortgage interest is going to reduce your taxable income and thus reduce your tax burden. So what's the connection? It's this. 14,000 times 1 minus 0.28 equals 14,000 times 0.78 equals 10,800. This is effectively the taxes that you pay. Another way to look at it is 14,000 times 0.28 is the taxes that you save. And if you wanted to run the math, you can say, okay, I paid 14,000, but we said that the 10,800 is the sort of actual tax adjusted number. We subtract that. And in fact, by having that mortgage, you're still paying a lot of money out every month. Don't get me wrong, but you are realizing $3,920 in tax savings. Okay. So that's an overview of how we get from what you earned, chip it down, chip it down, chip it down, chip it down, above the line, AGI, below the line, taxable income. That's how we move from what you earn to what you pay taxes on. The big takeaway here, you do not pay taxes on every dollar you earn. And if you're smart with your deductions, you can aggressively and legally reduce your taxable income, thus reducing your taxes, thus putting more cash flow in your pocket. And we know how that works in our wealth building system, okay? So we can see it in the numbers, we can see it on the tax form. And like I said, I put together this little skeleton, which takes you line by line, along with notes to help you get from total income to taxable income, to figure out your tax, to figure out if you get a refund or you owe something back, okay? So feel free to look at the skeleton, the tax return, immerse yourself in it. It's going to be wonky at first because the jargon's kind of weird. That's okay. We'll do some problems together when we're in class. But until then, look through this, and thanks for tuning in, and I will see you in the next video.